All right. Hi, everybody. Good afternoon, and thank you so much for joining our webinar today, Constructing HRA Blueprints for Solid Administration. My name is Amanda, and I'll be your moderator today. ERISA attorney Larry Gugine is our presenter. I know this is a topic that's on everyone's mind with some recent legislation. There's a lot of information here, so don't worry if you miss something. We'll be emailing you a recording and the slides after the webinar concludes. I'm going to keep everyone muted to make sure we don't get any background noise, but Larry will pause periodically for questions. Just hit the raise hand button and I'll unmute you so you can ask them. If you prefer typing, there's a question box below, and I can read them aloud for you to get your answers. Our next webinar will cover FMLA administration, and it'll take place on January 24th at 1 p.m. Central Standard Time.
You're weaving in and out of your audio is weaving in and out.
I apologize. I was saying our next webinar will cover FMLA administration on January 24th at 1 p.m. We hope to see you there. For now, I'm going to turn the presentation over to Larry.
Thank you very much. Appreciate it. HRAs, as employers, have increased deductibles at copays and coinsurance. Many employers have turned to HRAs to soften the blow on those high deductible plans. Now basically HRAs are employer money that the employer sets aside many times for unreimbursed medical expenses. Now remember, HRAs are ERISA plans. You need a plan document, SPD. I will go through all that. What Amanda indicated in the very beginning, there's a new HRA that is effective this year. It was part of the 21st Century Cures Act, and it's called a Qualified Small Employer HRA. At the tail end of the presentation, I have a number of slides describing that. The problem with it is the fact that so far there's been no IRS or DOL explanation of what that plan will entail. I will tell you right now what we know, so you'll be up to speed of exactly what's happening. But it's a new HRA. It's very exciting because for the first time in a number of years, that HRA will allow employers to reimburse individual premiums. Starting 14, employers were prohibited from doing that. So I will discuss exactly how that works, what the rules are at the tail end of the presentation. So let's get started on this. Well, what will I be covering? Well, I will. The most important feature of the HRA, which employees may participate, what expenses can be reimbursed, what ERISA requirements do apply here, what type of contributions are possible, what amount of the contributions are possible, and when are withdrawals possible. And one thing to contrast this with, because many times employers have HRAs along with health flexible spending accounts. And there are differences between the two. The uniform coverage rule that applies for health FSAs, it's saying, you know, if somebody elects to put $2,600 in their account, that $2,600 has to be available on day one. The same thing is not true with this. So there are differences. I will be pointing out the differences between these plans and health flexible spending accounts. You can have two at the same time, and I'll be discussing how the interplays are between the two. But there are similarities between the two. Now, the most common question I get on this is, well, I used to have a medical reimbursement plan. How is that different? And medical reimbursement plans were around for many years. And the major difference is that in 2002, the IRS came out with guidance that indicated that we're going to allow these health reimbursements. And the difference between the two is under the health reimbursement arrangements, an employer can allow an employee to roll over any amounts that are not used. And because it's employer money, it's permissible to do that. So what you can do, if you give somebody, for example, $3,000 a year and they only spend $1,000 of it, you can, as an employer, roll it over under an HRA for as many years as you want. And this is something that's allowable under HRAs. So what history? What is an HRA? Well, it's provided under a Revenue Ruling 2002-41 and IRS Notice 2002-45. And again, it's considered a welfare plan, a self-funded plan. And because it's self-funded, all the non-discrimination rules under Code Section 105H and ERISA do apply. Now, I just want to stress when you're talking about an HRA, and the major difference between HRAs and health flexible spending accounts, there's no pre-tax salary reduction contributions. So all we're talking about is employer money. Now, because it's employer money, you can decide who gets the contributions, when they get it, how much each year, so it can be very flexible. And you can decide, for example, what type of expenses that you're as an employer you want to reimburse. If you want to target a particular type of expense, you can do that, no problem. Now, in regard to who you want to admit to the plan, just remember that because it's a self-funded plan, the non-discrimination rules under 105H, which I'll be covering in a few minutes, do apply, and there's an eligibility test, so you can't, unlike an insured plan, you can't load it up with highly compensated. You have to include enough lower pays in order to pass the eligibility test, but you don't have to include everyone. As long as you don't have a concentration of higher pays in your plan, you can put an HRA in for a particular division, a particular location of your company. You can do that. And if you want to, and again, you don't have to, you can allow employees to carry over balances. The only problem that is it's considered an expense when you do that, because you owe that money to the employees. Now, what's important is with the passage of ACA, and this was starting in 2014, the government came out with a number of different rulings towards the tail end of 2013 that said that HRAs could no longer reimburse individual premiums for individual coverage. And some small employers were doing that, and the IRS said no, it's by allowing to do that, it's a violation of ACA, and the employer could be subject to a penalty of $100 a day if you continue to do that. Now again, because it's employer money, the employer controls what medical expenses they can reimburse, and it controls how much of an expense they will reimburse. So as an employer, what many employers do is that they'll say, okay, and for ease of administration, we'll design the HRA to piggyback on our group health plan. And whatever the medical plan, because of deductibles, co-pays, co-insurance, doesn't reimburse, bring it to us, to the HRA, and we'll reimburse it. And that way it's ease of administration, because instead of fiddling with receipts, all you have to do is tell the employee, bring the EOB, evidence of benefits, and show us that you weren't covered by the plan, and we'll reimburse you for that. Now also too, over the last 4 or 5 years, in regard to retiree medical programs, many employers over the past 15 to 20 years have done away with retiree medical programs. And some employers don't want to do away with retiree medical benefits entirely. So they'll say, okay, under the HRA, what we're going to do, we're going to give you X amount per year to fund either premiums or fund expenses, and we'll give you that benefit instead of having a full-blown retiree medical program. So employer can reimburse premiums or just expenses, and again, you can reimburse group premiums, but you can reimburse individual dental, vision, and various different voluntary benefits. You can do that. And remember, because it's a group health plan under ERISA, benefits do end when somebody terminates unless they elect COBRA. So there's going to be a COBRA premium that is associated with this plan, and you have to determine the COBRA premium, and I will cover that in the next few minutes. So what is it, when you do a program, what does it look like? Well, you have an ERISA plan document, you have an enrollment form, you have an SPD that explains the program to the employees, you create an expense reimbursement form where the employees formally submit the expenses, and if you have 100 or more participants at the beginning of the year, you have a form 5500. And then remember, because it's a group health plan, the summary of benefits and coverage, the SPC, does apply. Now what I do is I produce a special form and an annex or an appendix that attaches to the other SPCs, because if you load up all the material that should be in the SPC, it's going to completely confuse everyone. So I create a special SPC for HRAs. And then there's a summary of annual report, but you only have to give that out if you have to file a 5500. And basically what the summary annual report does, it just summarizes the information on the 5500. Now, starting in 2014, what the IRS indicated is that employers, you have to, in order to get a reimbursement from an HRA, you had to be covered by a group health plan. So the HRA and the group health plan had to be integrated. And again, the employer, as I said before, can designate which expenses can reimburse under the HRA. So you can do all the reimburses, all the expenses reimbursed for the group health, not reimbursed for the group health plan, or some. Now you don't need that restriction if you're just reimbursing dental, vision, or retiree expenses or premiums. Those benefits don't have to be integrated with the group health plan. So just the medical has to be integrated. Now there's two integration methods. One is if your plan does not provide minimum value, and the other is if it does. And there's limitations if it doesn't provide minimum value, limitations of what you can reimburse. If your plan does provide minimum value, the law says you can reimburse anything you want. It doesn't have to be limited to deductibles, copays, coinsurance. So you could reimburse all kinds of other stuff that the employer is interested in. But in regard to the first method, it's only deductibles, copays, coinsurance. And for expenses for dependents to be covered, to be reimbursed under a medical plan, they also have to be covered by a group health plan of the employer or of the spouse's employer. So again, the IRS has released guidance over the last probably 6 months to a year that indicated if you have single coverage, you have an HRA. And you cannot be reimbursed for your dependents' expenses unless they're also covered by a group health plan by the employer or the spouse's employer of that. So it's very important, and we call HRAs are not integrated, freestanding. So after 2014, the IRS and DOL said no longer can, if you're going to reimburse medical expenses, that plan, that HRA has to be integrated with a group health plan of the employer or the spouse's employer. Now also, as part of that guidance that came out in 2013, the employer must be offered, the employees must be offered an opportunity to permanently opt out and waive future reimbursements from their HRA, at least annually, and sometimes people want to do that because they want to participate in an HSA. So you have to give them an opportunity. And then on termination of employment, the HRA must be forfeited and must be allowed the employer to be permanently opt out or waive future reimbursements. So these are limitations that came out starting in 2014. It has to be in the HRA. Now again, you as an employer, and this is a very common question I get, you as an employer can determine your eligibility. You can determine which employees are eligible. But please understand that employer may exclude any employee as long as it passes the non-discrimination test under Code Section 105H. So the biggest question I get, well, if I adopt an HRA, do I have to include everyone? The answer is no. Now, like a health flexible spending account, self-employed individuals, partners, and more than 2% shareholders cannot participate on a pre-tax basis. So that same limitation that's in health FSAs also apply in HRAs. Must the ERISA requirements be met? Yes. Remember, an HRA is considered to be a self-funded plan. There has to be a written plan. And now, in designing this program, most employers don't fund it. What does that mean? It means that the employer doesn't set aside separate assets to pay for claims. Claims are paid out of the employer's corporate assets. So there's no separate plan assets, and there's no requirement that there be separate plan assets. You can pay the expenses and you can pay the claims out of a corporate account. But if you do want to fund the plan, if you do want to set assets in the plan name, just remember that ERISA also requires a trust. I don't see that too often in this situation, but again, that's something that's out there. So one thing that some employers get into trouble about is they set up a checking or savings account in the name of the plan, and that basically is funded, and so if that happens, then you have to set up a trust. All the rules on claims procedures, reporting and disclosure, and fiduciary requirements all apply to HRA just like they would under your group health, other group health plans. So again, it's a rather big commitment to set up an HRA because all these different requirements do apply. And we've had seminars in the past discussing in detail each of these requirements. Now, can an employer participate in a health FSA in the same month? And the answer is yes. So this is different than an HSA. You can, but please remember the FSA and HRA cannot reimburse the same expenses. There's no such thing as double dipping. So you've got to be real careful. The expense can be covered in both. The plan must specify that the FSA must be exhausted first, and if the plan does not specify, then the law says the HRA must exhaust first. So again, this is one of the things that I always ask clients, well, do you sponsor a health FSA? And if you do, which one? And the employer has to decide which one is going to be the first one that's going to reimburse expenses. Now, many employers do the FSA because that's employee money, and they want to make sure that the employees don't lose their money. So you got to think long and hard about this, and which plan will step up first and pay any expense. Do the health FSA rules to HRAs? No, because remember, there's only employer money, so the use it or lose it rule doesn't apply, and the uniform coverage rule doesn't apply. What does that mean? Well, as an employer, which you can say, you can make the contribution. For example, if you're going to give an employee $3,000, you can say, all right, we're going to give you $3,000, but you're going to earn it so much per month. So you don't have to give it out all at once at the beginning of your, many employers do, but you don't have to. You can divide it up, saying you're going to say, okay, you're going to earn a monthly amount of X. And the reason why employers do that is because in case an employer has a lot of high turnover, they want to make sure that only those employees that stick around for all of the plan year get the full amount. So if you're a company that has very low turnover, then there's no question you want to give the money to the employees as soon as possible. But if you have some problem with turnover, you want to think twice about giving that full amount that's made available. And again, it's up to you how much you want to give to the employees. And what many employers do in this situation, they set an amount at the beginning of the year and tell the employees, well, this year, if you give us expenses, we're going to reimburse up to this amount. So you as an employer could set the amount that you want to reimburse every year, and that's no problem. Now, what contributions are permitted and how they treated as tax purposes? Again, as I said, there's no limitation like there is under health FSAs. Reimburse participants for medical premiums or expenses up to the maximum dollar amount specified by the employer for the year. And you can reimburse all medical expenses, only those specified by the employer. Now, any contributions made by you, the employer, are deductible, and any amounts paid to the employees are not taxable. So it works just like any other group health plan. It's the same thing. There's no difference. And again, the reason it's an ERISA plan, you meet all the requirements of the various requirements under 105H and also all the different IRS rulings. As long as you do that, you have no problem. Again, can reimburse medical expenses and premiums. Okay, you can include dental, vision, and prescription drug and preventive care expenses. And again, I just want to stress in this situation, if you're going to reimburse dental, vision, again, the integration rules I just mentioned do not apply to those expenses. And again, can HRAs reimburse premiums for individual coverage? No. And again, the only exception to that, there was the small employers were given relief at the end of 2016. This is called a Qualified Small Employer HRA, which I'll be covering in a few minutes. And only certain small employers can have a qualified small employer, and employers with less than 50 full-time and full-time equivalent employees. And in order to use that qualified small employer HRA, you cannot be currently sponsoring a group health plan. So, and I'll be covering that in a few minutes. Can unused amounts be carried over? And again, this is a feature that the employer can put in the plan but not required to do so. And because it's your money, you're an employer, it's your money, you can say, no, there's no carryover, or yes, there are, and you can carry it over 2 years, or 3 years, or forever. But in the document, the employer must specify the carryover amount and the period, so you can say you can only carry over $1,000 a year. We want to encourage employees to spend the money, so we're going to specify the period and also the amount to be carried over. But again, the problem for the employer is that any amount allowed to be carried over will be considered an expense on the employee's balance sheet. So basically, it's going to be a debt that you owe to the employees. And as I indicated before, many employers have turned to HRAs to fund retiree medical accounts. What they do in this situation for retirees, they specify a specified amount that the employees can use every year, and they can use it for either premiums, like for Medicare, or for supplemental plans, or for unreimbursed expenses. And again, this is a promised amount. What many employers do, they say, if you stay with us for a certain period of time until a certain age, you get the benefit. And if you leave before your retirement date, you can lose that benefit. So again, this is something you can dangle in front of the employees. But again, what's interesting about this, and why many employers turned away from retiree benefits in the past, is because the fact that the costs were going up, and it was at what we call a defined benefit medical program, the employer had no control over the cost. Now, the employer in this situation can specify exactly how much that employee will get every year when they retire. So that's something that the employer can control. Okay, I'm going to stop right here. Amanda, do we have any questions?
Yep. If there is a carryover for the HRA and the employee leaves, what does the employer do with the money?
Basically, because remember, these accounts are not funded. So any amount set aside, it just goes back and is a corporate asset. So it's a debt that's relieved when the employee leaves. So now, again, the employees can continue to participate under the HRA if they continue to pay premiums under COBRA, which I'll be covering in a few minutes. But again, once that employee leaves, they forfeit all right to that benefit under that. So it's the employer is relieved of the obligation to pay that benefit.
All right. Let me see if there are any else. We don't have any more typed, so at this time you can select the raise hand icon if you have any questions, and I'll unmute you, or you can type another question below. We'll give it just a minute.
Sure.
All right, I don't see any, so let's keep going.
On this slide, slide 18, we asked the question, once contributions are made, can they be forfeited? And basically, amounts can be forfeited just like benefits under any medical program by events specified by the employer. Those include reduction of hours, those include termination of employment, death, of course. In all these situations, the benefit will stop, which will allow an employee, what will allow an employee to continue if they, and again, because this is a group health plan, the employer, if they lose eligibility, and it's one of the corporate qualifying events, the employer has to offer COBRA to that employee, and they can continue. And unlike a health FSA where it's a limited period until the end of the plan year, here it's a full either 18 or 36 or 29 months. So it's treated just like any other group health plan, and I will indicate in the next few minutes how you determine the actual premium for that benefit. And must the benefits be funded? And again, this is a very common question to get. No, it's paid out of corporate assets, and that's what most employers do. And so basically, even though you may see in the plan documents mentioning of an account, it's just a bookkeeping account, and most employers don't set money aside to pay the benefits. It's just paid through corporate assets. And this is under general assets as it indicates in slide 19. Are there any non-discrimination rules? There's both an eligibility and a benefits test. As this slide indicates under Code Section 105H, you have to, again, a plan is discriminatory for eligibility unless the benefits either 70% or more of all employees. 80% are eligible as long as 70% are eligible for benefits. And there's something called a non-discriminatory classification. And basically the last one indicates that you can't set up a classification that is a concentration of higher pays. And for this purpose, a higher paid is the top 25% in compensation or owners. So let's say you had a company where 10% of your employees were highly compensated, the rest weren't or whatever. You can't set up a plan just for them. You have to include enough lower paid people that you have to run the eligibility test to see that you've passed it. The reason why this is here is to indicate to you that there's a misconception that when you set up one of these plans, you have to include everyone. and that's not the case. But the first bullets were the eligibility tests, and the second is in regard to benefits. You can't discriminate in favor of highly compensated for benefits. You have to be very careful, and because every time you create a different benefit, a different class of benefit, a different waiting period, that's a different benefit that has to pass the eligibility test. So just remember that if you're going to set one of these things up, and if you don't include everyone in your plan, then you have to get someone to run the test for you to make sure your plan is not discriminatory. That's why that slide is there. When can distributions be made? And again, it's up to the employer to say, I'm going to reimburse every month, I'm going to reimburse twice a year, whatever. But again, it's up to you to decide when you're going to reimburse under the plan. You can decide what evidence you want to reimburse. Again, as I indicated before, you decide exactly what evidence you're going to accept. And the most common design in this situation is administration plan a lot easier, is that many employers say, okay, we're going to reimburse any expense not reimbursed by the medical program, and in order for you to get reimbursement under the plan, to show evidence the fact that you submitted that expense was not paid by the plan, give us the EOB, and then once you give us the EOB, we're going to pay you within 30 days. So again, here, because it's employer money, you can decide how much you're going to reimburse, when you're going to reimburse. And I think it's and that's why I think many times if an employer is looking at an HRA or looking at an HSA, this is one area that many employers like because, in fact, they can control when and how benefits are paid. Who substantiates that paid for medical expenses? And again, the employee submits claims to the employer or TPA. And again, as I indicated, the procedures for submitting claims are very similar to health FSAs. You have to submit evidence, and claims have to be substantiated. So either you submit an EOB or evidence of the expense. So it doesn't have to be paid, it just has to be incurred. What happens to an employee's HRA upon his or her death? Well, again, the spouse and the dependents can continue coverage under COBRA. COBRA is available, but that, of course, and any expense incurred by the employee before their death is paid. But COBRA is still available to any dependent that wants to continue coverage. So that's why that slide is there. And may an employer place any restrictions? And again, I have this slide a couple of times here, and yes, you can place on restrictions on what expenses were being reimbursed, the amount of the expense to be reimbursed, and when that reimbursement will be made. So again, this is a very positive restriction that many employers use. Does COBRA apply, and how is the premium determined? And again, yes, ERISA, yes, I mean, COBRA does apply in this situation. And unlike health FSAs, it's, as I indicated before, the full 18, 29, or 36-month period applies depending on the event that occurred. And qualified beneficiaries have access to unspent balances. There's been no guidance on how to split it up between the qualified beneficiaries, especially if you have people with separate accounts. Each qualified beneficiary will have an independent right for COBRA coverage when, that was available immediately preceding the qualifying event. And the most important question I get in this situation, the premium will be actuarially determined or alternatively determined using what's called the past cost method. What does that mean? Well, basically, determine COBRA premiums, what you do is you look at the plan. And over the last 2 or 3 years, let's say you offer a benefit of $3,000 a year. But the plan typically only paid $2,000 out. They didn't pay $3,000. What you can do as an employer, you can determine your COBRA premium on the amount that the employees used in the past as a way of determining so it's 1/12 of that $2,000, not to $3,000. And the plan is permitted to charge a qualified beneficiary up to 102%, just like any other situation of the applicable premium. And another question I get is, when electing COBRA, must the employer give a separate election for the HRA? Many employers do, some don't. You say if in order to get the HRA, you have to pick the group health plan under COBRA. They're tied together. That's what many employers do. It's up to you how you want to offer it separately or together. It's up to you how you want to work this. Does HIPAA apply? And because we're dealing with a self-funded plan, all the HIPAA rules apply. Portability, administrative, also HIPAA privacy applies. Now, there is an exception under HIPAA privacy, and again, because it's self-funded, there's a good possibility the employer is receiving and storing PHI. But there is an exception, a plan with fewer than 50 employees that's administered by the employer that is established and maintains the plan is excluded. So if you have a small employer, under 50 employees, the HIPAA privacy rules do not apply. But if you have a larger employer, they do apply. What reporting is requirement? Again, as I indicated before, because they're subject to ERISA, if you have 100 or more participants at the beginning of the plan year, there's going to be a Form 5500 required. You must provide a Form 1095-C if the plan is then integrated with a group health plan. Every once in a while you run into an HRA that's integrated with a health plan of a spouse's employer. In that situation, you would have to give out a form. And also there's something called Section 111 reporting. If your benefit is $5,000 or more, you have to, again, report to the CMS. There's a special report for them every year. What disclosures you have to give out? Well, remember there's a separate SPD, there's a separate SPC, and again, there has to be a notice every year that employees have an opportunity to opt out of any future reimbursement. So a separate notice has to be given out then. Now, why would an employer participate under an HRA? Well, as I've been stressing here, the benefit of an HRA over an HSA is the employer has a complete control over what expenses can be reimbursed, what unused amounts will be carried over, and for what period of time unused amounts will be carried over. And there's flexibility in how much, and you can decide each year how much you're going to reimburse. If you have a bad year, you may want to reimburse it. You may want to reduce how much you're going to reimburse. Other years you may want to increase it. And also, unlike HSAs, HRAs can work with health FSAs. So you can have both in one year. Why would an employer not participate? Well, as you well know, ERISA requirements are pretty complicated. And if you're not going to offer it to anyone, everyone, all your employees, there's non-discrimination rules that you have to contend with. Also, you have to make sure you substantiate all claims that are paid under your plan. And you have to be careful in regard to funding issues, making sure you have enough money to pay the claims under the plan and don't put any accounts in the name of the plan. And some actuaries have told me that if you sponsor an HRA, it may reduce the savings in going to a high deductible plan. They may consider that instead of having a $5,000 deductible, a lower deductible because you have the HRA. And also, what complicates the administration of the HRA is COBRA application. Those funds have to be continued and offered once that person terminates. Are there any questions?
Yes. Pardon me. Yes, we have several. The first is, recent legislation indicates the HRA premium payments need to be reported on the W-2. Why will this be subject to taxes?
It's not going to be subject. It just reported on the W-2. It's not subject to taxes. It's just going to report it. Yeah.
Yeah. Can S-Corp owners participate in the HRA as long as any payments received from the HRA are reported as income?
It's possible. There's no definite guidance on that, but it's possible.
Okay. How do employers typically determine if something is eligible for reimbursement? Do they review the requests and payout, or do they use third-party administrators?
It's a combination of both, depending on how complicated your plan is. Some employers, if they base it on integrated with the group health plan, they just use an EOB. It's much less complicated, and they may just pay in, for example, in-network out-of-pocket amounts. And so, Mr. Employee, you're directed to just send us the EOB and we'll pay it up to a certain level every year, and that's ease of administration. If you want to get more creative and you want to reimburse more expenses, then that's when I would call in a TPA. So it all depends the complexity of your design.
All right. Can you please give an example of the premiums that are reimbursed?
Under an integrated HRA, you can reimburse expenses. I'll give you an example. A growing trend is many employers will sponsor voluntary dental and vision plan programs. In that situation, what they may do is say to the employees, okay, here's X amount, and you can reimburse for dental and vision voluntary premiums and expenses. You decide how you're going to do it. So again, in that situation, you can reimburse individual dental and vision. Also, what you can do, you can reimburse preventive care expenses not reimbursed under the medical program. So those are examples.
And the last one, can employers reimburse individual health premiums if they establish an HRA?
Only under the qualified small employer HRA, which I'll be covering in a few minutes. So that's the next topic we're going to be covering. Now remember, for medical programs up until beginning in 2014 into now, now there was relief for small employers under 50. If they continue to do it, they weren't penalized. But technically, if an employer reimbursed individual premiums under an HRA, they could be penalized $100 a day per employee for doing that. It's a violation of ACA. All right, and that discouraged many employers because many employers, small employers, could not sponsor group health plans. They got too prohibitively expensive, and they just wanted to give the employees something. All right, and the problem with giving employees something is the government said in guidance in 2013, 14, and 15 is that the only way you could do it is if you gave the employees a bonus and didn't tie it to buying insurance. Well, many employers said, you know, I don't want to give my employees $5,000 and they could buy a car or big screen TV or something else. I want to be assured they get insurance, but the employer was prohibited from making that condition known. So on December 13th, the President signed the 21st Century's Cures Act, which established a new plan called a Qualified Small Employer HRA. These slides go into detail about this new HRA. So employers may adopt this HRA design starting with plan years that begin on or after January 1st, 2017. So again, this has only been effective for a few weeks. So for the employer to qualify to offer this plan design, the employer must employ less than 50 full-time and full-time equivalent employees. This is determined the previous calendar year. So there's a term called an applicable large employer. If you're an applicable large employer, meaning you're 50 or more, you can't use this. You cannot sponsor a group health plan, and you must offer the HRA on the same terms for all eligible employees. All right, so you have to be a small employer. You can't sponsor a group health plan, and they haven't designed yet. They haven't indicated yet what a group health plan is. So it's going to be interesting to see what they come up with. And you have to offer this to everyone who's eligible. Now, you can design the program to exclude certain employees. This is by the law. You can exclude anyone who's not completed up to 90 days of service, part-time, which is less than 35 hours, or seasonal, which is less than 9 months, any employees under age 25, union employees, or certain non-resident aliens. So all these people can be excluded from the plan, and you can do a 30-day wait, a 60-day wait, but you can't. The wait cannot exceed 90 days. So again, these are the people you can exclude. Now, if an employee, so therefore, what I'm trying to say is, if you have somebody that's worked for you and has worked for you for years, and they're full-time, they're eligible. So you can exclude them. So unlike the other HRA, this one is very limited on who you can exclude. Now here's the amount you can. Reimburse up to $49.50 for single coverage and $10,000 for family coverage. So you could give anything up to that, and those limits will be increased every year. There's a cost of living aspect of it. That amount is prorated for any employee who worked only for part of the year. And these are just employee contributions. We don't know whether this HRA and a POP plan will work together. We don't know that yet. I don't think it will, but we have to get guidance on this yet. Now, the employer can vary the amount of the reimbursements available under this arrangement based on the age of the employee and family members, or the number of family members of the employee covered under the plan. So you can say for individual it's X, for employee and spouse it's Y, for family it's Z. You can do it that way. And any variation must be made in accordance with the variation in price of the insurance policy and relevant individual market. And remember, the individual market premiums will vary depending on the age, and you can give older workers more money. So for this purpose, any variation must be determined in reference to the same insurance policy with respect to all eligible employees. So everybody at a certain age must get this. Depending on the coverage they have, you can do it. So these are the variations that are permittable. And HRA may be designed to reimburse all 213 medical expenses, and this includes medical expenses and health insurance premiums. So again, this is a departure from the other rules I just mentioned. So here you can reimburse health insurance premiums. Now, we don't know at this point what's going to be allowed. And the biggest question I've been getting here is, are they going to allow reimbursement of Medicare, Part B premiums, Part D premiums, and also supplemental policies? Are they going to allow that to happen? And we don't know at this point. Another question I've been getting is, suppose you have a employee that's covered by the spouse's plan. Will that be allowed? We don't know that either. So again, clearly, if you have an individual policy that you bought on the exchange or you bought from a broker and it's individual coverage, clearly that can be reimbursed under this plan, and what you have to do is present evidence of that. This is the condition to receive tax-free reimbursement. The employee must show proof that he is covered and a minimum essential plan when enrolling. So if you show proof, the fact you have a premium, after enrollment the employer must provide the following as proof of continued coverage: either an EOB or monthly premium bill. So there's substantiation that has to go on. Now, participants may be taxed on their reimbursements if the participant is not covered by minimal essential coverage for any month during the year. So again, if you're not covered, you're going to be taxed on it. If you are covered by minimal essential coverage, you will not be taxed. And the question is, will it be up to the employer to police this? That's the question. Now, also, it's up to you, the employer, to provide a written notice 90 days in advance of any plan year. Of what you have to do is you have to disclose to the employees the amount of the HRA benefit available for the year, instruct employees to provide the amount of the HRA benefit available to the public exchange, that it could affect their premium tax credit. Because remember, if you get affordable coverage, then and you're not, so these reimbursements could affect your eligibility for premiums. Also warning employees that if they don't have coverage, they're going to be taxed. Now, the failure to provide this notice would trigger a $50 per employee penalty up to $2,500 a year. And if you want an example of the notice, I've created one, and send me an email and I will give you a copy of it. I just prepared it because many people want to get jump started right away, and you have before you can, and so far there's been no relief on giving this notice out, so you have to give it out 90 days before. Now, so an employee who has provided this HRA is not eligible for premium credits if the HRA is affordable. Affordability for this purpose is computed in a manner similar to other employer coverage, and this HRA is considered affordable for any month if the excess of self-only coverage under the second lowest silver plan in a relevant individual health market over the 1/12 of the employee's. In other words, what we're saying, if the employer gives enough money to the employee that exceeds 9.9% of their household income, then they've been given affordable coverage, and because of that, they would not be eligible for premium credits. That's what this is trying to say. The HRA must be reported on the employee's W-2. Now, what that means is, it doesn't mean it's taxable. It's there to show the employee what they got, and I think the reason why they're doing that is to show the exchange what they got and show the IRS what they got. So it's going to, again, that information is probably going to go to the exchanges, and that's the reason why it's there. Now, a big help in this situation is the HRA, this HRA is not subject to COBRA. So COBRA doesn't apply here. Now, consequences of failing. Suppose you go over 50 and you forget and you continue to do reimbursement. Suppose you don't satisfy any of the requirements. You don't include everyone. You fail one of the requirements. The problem is, in this situation, the problem is if you fail any of the requirements of eligibility, you don't include enough people, you're 50 or more, the problem is then that HRA reverts back to a normal HRA, and if it's not integrated with a group health plan, the problem is you're going to be subject to that penalty of $100 a day. So again, and also too, you have to file a 1095B or C. You have to make sure you look at the requirements, you cover everyone, you reimburse the right amount, also you meet the requirements of substantiation. As long as you meet those requirements, you have no problem. And once you blow one of the requirements, as this indicates in this slide, then you're subject to a penalty. Are there any questions?
Oh, we have plenty. The first one, so regarding who can and cannot be involved in an HRA. So the employer cannot create different classes and provide like a certain dollar amount to one class and a higher dollar amount to another class under this new HRA?
No, no, no. It's based on coverage. It's based on coverage.
Yeah.
So it's not based on employee class. It's based on coverage.
Mm-hmm.
So you get somebody with single coverage. You get somebody with single coverage one amount, family coverage with another amount, somebody with spouse and employee coverage another amount.
Mm-hmm. Why is the part-time threshold 35 hours for this rather than 30 hours?
Because it's based off of the exclusions under Code Section 105H. If you look at 105H, those are the exclusions.
Okay. Can you offer a group dental or vision plan along with an HRA for individual medical plan premium reimbursement?
There's been no guidance on that. I think you can, but again, let's wait for guidance.
Can the HRA premium offering be made to part-time employees?
You can always be more generous.
And then does the employee have to pay to participate in the small group HRA?
No. It's all employer money. It's all employer money. So it's basically no salary reduction. It's all employer money.
Okay. That's all I have for typed questions at the moment. If you have any other questions, please just click the raise hand icon and I can unmute you to ask them, or you can type them below. Other than that, thank you guys so much for joining us. We'll see you again in exactly 2 weeks.
Stop. Let's, one final word. I'm sorry. One final word. I expect IRS guidance shortly. It would be very important to advise you that I would wait to participate under this plan until we get more substantial IRS guidance. There's only been the law that was passed and signed by the President on December 13th, and then a series of questions that were released a few weeks ago. Other than that, there's been nothing else. So I would advise you, before running off and doing this, I would wait to see if the IRS is going to release more guidance, because the biggest question I have right now is, one, they're telling me for certain purposes this is not going to be considered to be a group health plan under ERISA. What does that mean? Two, doesn't sponsor a group medical program. What does that mean? That the group health plan, does that mean just the health plan or dental and vision? So these are things that have to be settled, and be very careful if you want to do this. And I think it's a very important benefit, and especially if you're thinking about either offering it to your clients, offering it to your employees, be very careful. And again, remember, because ERISA still applies here, you have to give your employees a SPD, and you have to have a plan document. And please be very careful with the substantiation, because if you get audited, and the problem is if you don't comply with the rules, then you're subject to a $100 a day penalty. So be very careful. All right. Thank you very much, everyone. Hope you had a good day. Oh, and if you want a copy of that notice, there's my information. Send me a request, and I'll send you a sample notice. Take care, everyone. Bye-bye. Amanda, is there anything else?
No, we had one question that was previously answered, so I was just directing them back, which was regarding whether an employee can receive the premium tax credit if they have an HRA, which for the small business, which is if they have.
Okay.
If
it's affordable, they can.
Yeah. All right. Other than that, we don't have anything. So I hope you all have a great couple of weeks. We'll see you again on the 24th, at 1 p.m. Central. You can register at benefitexpress.info, and we'll talk to you soon.
Take care. Bye-bye.
Bye.